Welcome to this video on solvency ratios. This is one of the many tools that is used in analyzing the financial health of a company. By solvency ratios, we mean the long-term solvency of a firm. And what do you mean by long-term solvency of a firm? That is whether or not a company will be able to meet its fixed long-term obligations. With long-term obligations means those which it has to pay back beyond a period of 12 months or beyond a period of 1 year. And with, for example, if you have debt funds or debentures in your capital structure, you will have to pay interest to the debenture holders regularly every year, every month, isn't it? And also you will have to repay back their amounts. So these ratios assess whether the company will be able to repay as well as pay the fixed interest charges on a regular basis. Does it generate enough funds, and what does the financial balance sheet show? And these ratios are usually expressed as a percentage. It can be expressed as a percentage, it can be expressed as a decimal, it can also be expressed as a pure ratio. Okay. Now, the ratios, these are the different types of solvency, long-term solvency ratios, most common ones. And the ratios up to fixed assets ratio or fixed assets to total long-term funds ratio. These are, for calculating these ratios, we use the information provided by the balance sheet. Hence, they are also called as position statement ratios and the balance sheet ratios. The interest coverage ratio, debt service coverage, fixed assets coverage, and cash flow coverage ratios are interstatement ratios or mixed ratios. They are computed based on the figures provided by both balance sheet as well as the income statement. Let's see these ratios one by one. The first one is the debt equity ratio. It is calculated by dividing the long term debt of a firm by the shareholders' funds. And what does this ratio show us? Why is this particular ratio calculated? This particular ratio shows what is the safety margin available to the long-term creditors just in case a company goes into liquidation. Compared to equity in the capital structure, what is the proportion of the debt in the capital structure? The ratio can go about 2:1. That can be as twice as equity, but beyond that is usually not compared. This is not considered desirable. So a high debt equity ratio means that the debt component in the capital structure is too high, which is risky, because just in case the company goes insolvent, the creditors, the long-term creditors, there is a chance that they wouldn't get back their amounts back. Lower ratio shows that equity component is more in the capital structure, but too low debt equity ratio means the equity component is too low. That means it is not making use of the financial leverage. That is, it is not using enough debt in order to magnify the returns to its shareholders. So that is all about debt equity ratio. And the total debt ratio, it's also known by the name debt ratio or total debts to total assets ratio. It is calculated by dividing the total debts by total assets. So what proportion of the total assets of a company are financed by the total amount of debt, the total amount of debt capital? And this here the total debt includes short term as well as long term. Total assets include all the assets including tangible and intangible assets. This ratio is a complementary ratio to the equity ratio, which we will soon see. It is calculated as 100 minus equity ratio. If you are given equity ratio, you can compute debt ratio. So this is also known as solvency ratio. In some textbooks, you can see this as solvency ratio. Total debt by total assets. Now, what does it indicate? The proportion of the assets that are financed by the debt capital. And higher the ratio means more assets are being financed by debt. A low ratio means more assets are financed by the equity capital. And vice versa. So, like how I told you, a too low ratio would mean that total debts are too low, more of equity is being used. I told you, if the firm is not making proper use of leverage, it can have too low ratio. That is also not good. So too high and too low is also not good. We have now funded debt to total capitalization ratio. The funded debt to total capitalization. Funded debt refers to the long term sources of funds, long-term borrowings of a firm in the capital structure, like debentures, bonds, and all. No, and total capitalization refers to a total of all the long-term funds available to the business. As you can see, the calculation here, it includes share capital, both equity and preference, all the reserves, all the outsiders funds like debentures, loans, and bonds, and all. About a 50 to 50 percentage of the ratios tolerable. It means out of the total capitalization, a firm can have about 50 percentage or 55 percentage of the amount capital as funded debt or long term borrowed funds. More than that means the firm might be using too much of leverage, which, as you know, might increase the risk. They